Dear students, I am Dr. S. Sampath, Assistant Professor, St. Joseph College of Arts and Science. In this video, I am going to explain about the methods of purchase consideration. You may hear about amalgamation, absorption, and external reconstruction. In the modern business, due to the technological advancement, due to the economic scale of operation, due to the globalization of trade and industry, now all the companies they have to think about is a combination or merger, acquisition, and reorganization. Nowadays, all the companies they are thinking about this kind of combinations. It's also necessary and they not omit this kind of combination to overcome the competition to succeed in the market. Nowadays, the companies they have to think about this kind of combinations. In this video, I'm going to explain the meaning of amalgamation and then the meaning of absorption and then meaning of external reconstruction. Right. First, I'm going to explain the meaning of amalgamation. Amalgamation, right? For example, a company they want to tie up or they want to combine with another company. It is called amalgamation. It means it's a combination of two companies for a business purpose to overcome the competition to succeed in the market. Two or more companies enter into the market, and then if they start that new entity or new company, that is called amalgamation. For an example, here A Limited and B Limited join together, then start the new business AB Limited. So this A Limited and B Limited interested to combine their business, and then they start the new business as AB Limited. For the welfare of the company, to strengthen their business, both the company from their point of view, to strengthen their business, now they enter into the tie-up, now they enter into the combination, now they are started in the new company. Now they are going to function in the new name as a AB Limited. So amalgamation means two or more companies, and then they join together and they start the new entity, that is called amalgamation. The next one, absorption. Absorption means if one existing company take over the business of one or more existing company, it's called absorption. Normally in practice, typically the small companies are absorbed by the big companies. Those companies those companies not have adequate resources. So now what happened? The big companies they absorb the small companies because the small company may have some resources or they may have some skilled labors. So for that purpose, the small company is absorbed by big company or any existing companies take over absorbed by another company. Absorption means one company absorbed by another company, that is called absorption. Here A Limited and B Limited. Here B Limited. Here B Limited is absorbed by A Limited and the functioning in the new name A Limited. I repeat, here there are two companies A Limited and B Limited. Now A Limited absorbed the business of B Limited. It means the A Limited fully take over the business of B Limited, and then hereafter they are functioning the name, the existing name fully as a Limited. So after absorption there is no B Limited, only A Limited. So absorption means one company fully absorbed by another company, that is called absorption. And then second one, external reconstruction. External reconstruction means when existing companies liquidated and new companies formed with the same kind of resources, with the same shareholders to take over business, that is called external reconstruction. Normally reconstruction means they are going to make some modification in the structure of the company. Here External reconciliation means that modification done by the company with the help of the external resources, with the help of external forces. Here, in this example, A company is fully reconstructed, and then hereafter their A company will be functioning in the name of B Limited. So A companies put some modification in their assets and liabilities, and hereafter A company will functioning in the name of B Limited. That is called external reconstruction. Now come to the purchase consideration. I am going to explain about purchase consideration. Purchase consideration, it means the amount or the money or the price payable by the purchasing company to the vendor or to the selling company as a consideration for the purpose of take over the business. That agreed price or determined price is called as a purchase consideration. It means one company purchases the business of another company. Those company purchasing the business, they have to pay the consideration, they have to pay the money to the selling company. That is called a purchase consideration. Right. The next one, methods of purchase consideration. Normally there are four methods of purchase consideration. First one, lump sum method. Second one, net asset method. Third one, net payment method. And fourth one, intrinsic value method. First, I will explain the lump sum method. Under the lump sum method, the purchase consideration paid by the purchasing company in a lump sum amount. There is no installment. Suddenly, the purchasing company paid the entire amount to the selling company. That is called lump sum method. Second one, net asset method. Under net asset method, the purchasing company take over the assets of the selling company. The existing value of the net asset, that is called purchase consideration. Here I am going to explain how the net assets should be calculated. In this model, or in this case, the purchase consideration will be treated the value of excess amount or the value of excess assets over the liabilities taken over by the purchasing company. In this case, the assets are taken over by the purchasing company at the agreed value, excluding fictitious assets. Here, excluding fictitious assets means like the profit or loss account debit balance, discount on issue of debenture. So these are fictitious assets. So at the time of purchasing company take over the assets of the selling company, and they may not take the profit or loss debit balance, a discount on issue of debenture, those kind of assets. Other assets taken over by the purchasing company at the agreed price, and then less liabilities taken over by the purchasing company, excluding shareholders fund. So these are the some of the points we have to consider, we have to think about at the time of calculation of net asset. In asset side, asset means that assets include cash balance, bank balance, goodwill and prepaid expenses. Asset should not be taken. The asset means it not never include miscellaneous expenditure, and any assets not taken over by a purchasing company should not be included. They suppose if any assets is the purchasing company is not interested to take the particular assets of the selling company, that asset should not be taken for the purpose of calculation of purchase consideration. And then all assets of the selling company should be taken at the revalue. Suppose any revalue they were suggested, that revalue amount should be taken. In liability side, liabilities means only the liabilities should be taken at the agreed price. Liabilities include, it will never should be added or it never include the shareholders fund, share capital, reserves, accumulated profit, profit and reserve. Okay, this kind of portions should not be taken into the liabilities. Right. Uh, Next one, under the net asset method, liabilities include the trade liabilities and third parties liability. For an example, creditor, bills payable, bank overdraft, debenture, outstanding expenses. Only these kind of liabilities will be taken, or the tax liabilities. Tax liabilities, profit sharing fund, workman compensation fund, those things should be taken for the purpose of calculation of net asset. The next methods of purchase consideration, net payment method. Under the net payment method, the purchasing company pay the purchase consideration based on the payment they are agreed to give the amount to the selling company. So all the payment made by the purchasing company to the shareholders of the selling company, or to the equity shareholders of the selling company, or to the preference shareholders of the selling company. So what agreed amount they are ready to pay, that should be taken as a purchase consideration. So here some of the points we have to remember. When all the payments are given clearly, do not taken into asset, do not account for assets and liabilities. Payment to debenture holders, creditors, or any other third party liabilities of the selling company, liquidation expenses of the selling company, or the expenses paid by the purchasing company should not be included at the time of calculation of purchase consideration under the net asset method. The next one, intrinsic value method. Under the intrinsic, or otherwise is called the exchange value method or the share exchange method. Under this method, purchase consideration is assigned on the basis of exchange ratio. For example, purchasing company is ready to take one share from the selling company, and then they're ready to give 2 shares to the selling company. Or otherwise, the purchasing company take 2 shares from the selling companies, and then they're ready to give 1 shares from the purchasing company. So that is called intrinsic value method or the share exchange based method. So this is also one of the methods of purchase consideration. In this method, the exchange ratio is generally determined on the basis of the value of each company of shares. Thank you.